Welcome to the Riskwiser Zone, the show where we dive into the world of stocks and finance to help you make informed decisions about your investments. We're starting off with a story that's been making waves in the financial markets. The US dollar has fallen amid concerns over a potential intervention by Japan to prop up the yen. The Bloomberg Dollar Spot Index dropped 0.4% as investors weighed the possibility of Japan stepping in to support its currency. This comes after the yen rose 1% to 14122 per dollar, sparking speculation that Japanese authorities may intervene to prevent further weakness. The motivations behind a potential intervention are complex, but it's clear that Japan wants to stabilize its currency and prevent any further damage to its economy. A weaker yen makes Japanese exports more competitive, but it also increases the cost of imports, which can lead to higher inflation and lower consumer spending. Meanwhile, gold has surged past $5,000 an ounce for the first time, extending a rally fueled by investor demand for safe haven assets. Silver has also jumped, crossing $100 an ounce as retail buyers from around the world snap up precious metals. We're also keeping an eye on developments in the US, where concerns about another government shutdown are growing. Senate Democratic leader Chuck Schumer has vowed to block a massive spending package unless Republicans strip funding for the Department of Homeland Security, raising the risk of a partial government shutdown. As we navigate these complex and interconnected markets, it's essential to stay informed and up to date on the latest developments. That's what we're here for on the Riskwiser Zone, to provide you with balanced and unbiased analysis of the news that matters most to your investments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, folks. We're glad you're still with us as we dive into the world of savings and investments. Today, we're looking at some of the best rates out there for CDs, money market accounts, and high-yield savings accounts. Now, I know what you're thinking, Lewis. Why should I care about these rates when the market is so volatile? Well, my friends, it's precisely because of that volatility that having a solid foundation in your financial portfolio is more important than ever. Let's start with CDs, or certificates of deposit. These are essentially time deposits offered by banks with a fixed interest rate and maturity date. The best CD rates today are hovering around 4% APY, which isn't bad considering the current economic climate. Of course, you'll need to lock your money in for a set period, but if you're looking for a low-risk investment, this might be a good option. Next up, we have high-yield savings accounts. These accounts are similar to traditional savings accounts but offer higher interest rates. Some of the top accounts out there are offering rates of up to 4% APY, which can add up over time. The beauty of these accounts is that you can typically access your money when you need it, making them a great option for emergency funds or short-term savings goals. Last but not least, we have money market accounts. These accounts often come with debit cards and checks, making them a bit more liquid than CDs. The best money market account rates today are around 4.1% APY, which is quite attractive. However, keep in mind that these rates can fluctuate, so it's essential to shop around and compare rates before making a decision. As we navigate the complex world of finance, it's crucial to remember that there's no one-size-fits-all solution. What works for your neighbor or colleague might not work for you. That's why it's essential to do your research, consider your financial goals, and consult with a professional if needed. In conclusion, whether you're looking to save for a short-term goal or build a long-term nest egg, there are plenty of options out there that can help you achieve your objectives. Just remember to stay informed, be patient, and always keep your financial goals in mind. Welcome back to the Riskwiser Zone. Today, we've been discussing various aspects of personal finance and risk management. As we wrap up this episode, let's take a look at some current market trends that may impact your financial decisions. We've seen interest rates on home equity lines of credit, or HELOCs, and home equity loans averaging in the low to mid 7% range. This could be an important consideration for homeowners who are looking to access some of the equity they've built up in their properties without refinancing their primary mortgage. A second mortgage, such as a HELOC or a home equity loan, can provide a way to tap into that equity, but it's essential to understand the terms and risks involved. For instance, HELOCs often come with variable interest rates, which means your monthly payments could increase if interest rates rise. On the other hand, home equity loans typically offer fixed rates, providing more predictability in your payments. It's crucial to shop around and compare rates from different lenders to find the best option for your situation. Some lenders are offering competitive rates, such as LendingTree's HELOC APR, as low as 6.36% on a credit line of $150,000. However, it's vital to remember that these rates can fluctuate, and you should ensure you can afford the monthly payments if your rate increases. As with any financial decision, it's essential to weigh the pros and cons carefully. Using a HELOC or home equity loan to access your home equity can be a viable strategy, but it's not without risks. You should consider your overall financial situation, including your income, expenses, and debt obligations, before making a decision. In conclusion, when considering accessing your home equity, it's crucial to approach the decision with caution and carefully evaluate your options. Remember to always prioritize your financial stability and security. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.